talk now to Marcel von Aulock, who is CEO of Tsogo Sun. Their full year results today. Good evening to you, Marcel. A lot of stuff in your commentary about things that you're fixing, new things you're doing, expanding here, moving there, license applications in Mpumalanga. What's the core of the latest set of results for you?
So I guess it's two stories. One, we've stuck to our expansion strategy. These things take a long time, especially when you're building. So we've been investing heavily in both our hotel and our gaming portfolio. We've expanded our casino operations capacity-wise. We've got regulatory approval to do about 30% in Gauteng, and we're looking at about 30% in KZN. Those projects are continuing. We had a very busy year acquisition-wise, and we had to manage the exit of SAB Miller, which was a end of a 45-year relationship, so a lot of money went into that because we could buy back a big chunk of stock at a deep discount. That's sort of the one story that we've stuck to. The other side of it is that we've had slow growth, and that's not where we want it to be. We're coming off 3 years of 20% a year earnings growth, and this year we're flat. I guess you can't cry too much about earnings being flat in this environment, but we are seeing the consumer under pressure. We are still highly cash generative, and that's why we are keen to keep our growth projects going.
So you're growing by acquisition rather than organically through more consumer spending.
Yeah, I mean the key number that worries us was casino win grew by 2% last year. Now that's organic. The portfolio was the same. If you're growing your casino win by 2% and you're giving staff wage increases 7.5%, that can't continue forever. But we do think over time the growth in the casino win will normalise.
Yeah, you did mention the consumer under pressure. I think people had thought to a certain extent, gambling revenue, gaming revenue was slightly insulated against a downturn in consumer confidence, this consumer situation. So are you seeing a real strong downturn in the consumer? Is that what's causing this surge?
So the whole concept of casino win being defensive, we say is still intact. In this environment, we still grew by 2%. So we made as much money as we did the year before. What you're not seeing is high levels of growth. And our view is that long term, you should grow by nominal GDP plus a bit. So you'll find you'll track the wealth of the consumer over time. One thing that impacts casinos particularly is sentiment. So when things are good and everyone feels happy, you get exponentially higher growth. When things are bad, like they are at the moment, and people feel miserable, that's when people pull back on their spend.
I thought it worked both ways, that when they're miserable they say let's go out, but you find it doesn't.
Something like load shedding is a fascinating thing for us. It's cost us over the last few years 200 million in infrastructure to put all the generators in. It costs us diesel to run the facilities. We benefit in that place like Monte Casino is completely under generated power, all the restaurants are open, movies work, etc. But it doesn't help the casino because sentiment is bad. People are miserable. They don't want to leave their house when it's dark. They want to deal with traffic. It's a more important factor for us from a sentiment than it is from actual disruption of trading.
Yeah. You're talking about the split between, of course, the entertainment, like food stuff, and the casino gaming part of the business. What's the split there, and what do you see going forward as being the more important part of that business?
So obviously in our numbers, casino win makes up a big part of our business. It's about 75% of our revenues, the other 25 being hotels, food and beverage and so on. If you take what the casinos offer overall, it's a lesser number, it's about half. But that's only because most of the restaurants at a place like Monte Casino are tenants, so we don't record them in our numbers. But the total level of spend is much higher than what you see from us on that entertainment world. And it stays important because casinos in South Africa are a very local market. It's regular repeat visits by people that live in the area. So you've got to keep it attractive, you've got to keep the shows on, you've got to have the right movies, you've got to have the right restaurant offerings. It's not like Vegas where you fly in and fly out.
It's interesting you mentioned the generators, and we were talking medical companies earlier. Netcare, of course, has invested hugely in diesel generators. You're going to have special accounting line items for this kind of spending. Looking at the hotel portfolio, I think your occupancy was down there by about 1.1%. And of course, that, unlike the casinos, you've got this capacity that has to be looked after even at a basic level. And I think your key ratio there is revenue per available room, because you've got all these rooms, and what's the revenue? And that number was 62.8%. How does that sit historically with you, say, over the last 10 years?
So the hotel market, if I separate Africa and South Africa for the moment, South Africa is well below the long-term trend. Occupancy should be 68 to 70, and we're sitting at the sort of 62s. What's interesting in our South African hotel market, we're actually seeing an element of underlying strength come back. So occupancies from corporates, from leisure, Conventions, that sort of thing is up. Our numbers are backwards because of the large amount of government travel that's cut back. They've announced this austerity measure. We say just in our books alone, it was 92,000 room nights that went out the system. So that's a completely different segment to the rest. What I take comfort from is that if corporates are starting to spend, that kind of indicates some sort of light at the end of the tunnel, because it's a line item that every FD cuts quickly, is travel spend and so on. And we're starting to see some decent numbers coming through that.
That's encouraging.
But it's still well below the long-term norm. I mean, we haven't come out of the dip.
Just a little more, on a more macro image, of course, with the latest xenophobic attacks, etc. Have you seen any kind of negative impression or any negative impact on the casinos from international visitors?
No, South African casinos have very little international customers. It's very much a local market. I'd say it's less than 1% comes from foreign.
And your hotels' business travel is local?
In our case in particular, it's business travel local and leisure local. We have seen in the bigger industry impacts from the xenophobia. You have markets like China that are just incredibly sensitive. And when you got the visa issue, and you get something like bad news around xenophobia, it's so easy for the travel agent in Hong Kong to just direct the next couple to Paris or to somewhere else. And so that type of thing you see coming through. But by and large, we're insulated from it because we are so locally focused.
You're also doing interesting things with the property portfolio to be listed. You'll still keep control of it. We're talking a value of 30 billion here. So what's behind that?
So look, our total properties we think is in the value of 30 billion. We're talking about taking out everything except the actual casinos. Casinos are a bit like hospitals. You battle to split PropCo and OpCo because your licensing is directed to a specific site. The balance of our portfolio is a big hotel portfolio where we own most of the stock. We have, by default, developed a lot of office space, a lot of retail around the casinos and so on. And many hotel and gaming companies have done this around the world, where you split the properties into a specialist vehicle, a REIT, where you get tax advantages, and you keep the operations. We're doing it, I guess, threefold. Firstly, there's a management focus change that happens. You get specialist real estate people in your property side, and you keep your hotel operations on hotel operations. We can access funding better, because if you put the properties in a specific vehicle, there's a whole different set of investors that give you different levels of gearing to it. And lastly, it allows us, in our particular case, to access capital in that property vehicle without diluting our shareholders at the top. HCI have 48% of us, they control us. They've worked very hard to get there. We've just bought back 2.8 billion rands of the stock. We don't want to issue shares willy-nilly at the top, but we can access funding and do JVs at a property level much easier.
Yep. When's that going to happen?
So we're investigating it at the moment. We haven't made a firm decision on whether to do it or not, but if we're going to do it, I want to do it this year. It's not something we want floating around for too long. We need to assess what is right and can it work, and then get it done.
Yeah. One last question there, Marcel. Capacity for upswing, when the turn comes, you've got available rooms, you've got available capacity, and you've kept expanding, so you're well placed.
We are. I mean, it's a strong business, and we've said that ultimately the South African economy will work. It'll go through these cycles. The operational gearing in our business is enormous. The difference when we're growing revenue by 8% versus 2% is like double digit on the bottom line, and that's essentially what we're gearing ourselves for.
Well, interesting stuff from Marcel von Aulock, who is the CEO of Tsogo Sun.